lecture series on Indian financial markets and institutions. In my previous lecture, I talked about evolution of Indian financial system, and the evolution of financial system was being categorized in three broad categories, that is the pre-independence era, the post-independence from 1951 up to 1991, and then after the 1991 when we liberalized our economy. So this is the time, in the third phase I would say, the Indian financial system has come of its age, has a lot of work has taken place to liberalize the economy, to make the economy more vibrant. In order to make the more economy vibrant, financial system, developed financial system is a must. When I say developed financial system is a must, I will say developed insurance sector, developed mutual fund system, developed banking sector, non-banking finance companies, and the intermediaries, the merchant bank, the investors, the venture capitalists, the seed capitalists, and whole host of intermediaries are required to make the system more vibrant, to make the system an efficient system, to strengthen the system, right. So the post 1991, we take various measures to improve the and the from public ownership to private ownership. The regulations, means the stock markets, has developed to a great extent in this 1991, after post 1991 era, and the mutual fund industry, the insurance sector, the many private sector, in the private sector insurance companies starts operating. So this expansion, major expansion of the Indian financial system has taken place post 1991. Even in the government securities, market, the money market, the capital market. So the government securities, government debt, RBI floats nowadays thousands and thousands of crores of rupees of bonds that is being subscribed by the people. So the size has expanded to a great extent due post 1991. I will be just talking about a few reforms, 2-3 reforms that has taken place recently. So consolidation of public sector banks has been initiated by the government to strengthen them, and the number of public sector bank has been reduced from 27 to 12 in 2021. Normally we often argues that if the balance sheet size of the bank is very large, is big, when I say balance sheet side means the assets liability side, right. So if any bank which has a very large capital base, it can operate at a larger level, it can give loans, it can give credit, right, and it can raise money not only at the national level but at the international level. So in order to better govern the banking system, the 27 banks which were working before the 2021, that is the all the public sector banks, which were majority of the shares are being owned by the government, they have been reduced to 12. Basically the idea was to merge various commercial banks so that the size of the commercial banks expands, their balance sheet size increases, so that the efficiency increases, so that they can lend the money on a larger scale, so that they can raise the money at a larger scale. The capital adequacy of the banks can improve. For example, like here I have taken that Punjab National Bank, the Oriental Bank of Commerce and the United Bank of India was merged into Punjab National Bank. So these three banks, these itself were a large banks, but these were being merged into one bank. Nowadays it is known as only the Oriental Bank, and the United Bank has been merged into Punjab National Bank. Similarly, in the State Bank of India, other banks were being merged. So various banks were being merged, and from 27 after the merger, the 12 public sector banks are operating in the country. So consolidation of the public sector is one of the very significant reform that has taken place recently. The whole idea of merging the commercial banks is to increase the size of the balance sheet. When I say size of the balance sheet, means expand the size of the banking itself, so that better governance can take place, so that the capital adequacy can improve, so that it can borrow the money, it can take the money at a not only in the national market but also international market, and also lend more freely. The government is also proposing to reduce the equity stake in public sector banks to 33%. Nowadays, all the public sector banks have ownership of more than 50%. Some have 70%, 80%, right? So, the long-term objective of the government is to reduce the public ownership, that is the government ownership, to the extent of 33% in these banks, right? So, this will lead to the privatization of the banks. These banks can be operated in the private sector. The other recent reforms introduced in the banking system is to provide liberty to the banks to increase or decrease the authorized capital without restriction on the overall limit. In any financial system, banks are the major component of the financial system. So, if the banks, the idea of the government is to give more reforms, more liberty to the banks to increase or decrease the authorized capital. So, whenever the need arises, whenever they feel that for maintaining the capital adequacy ratio, for improving the capital adequacy ratio, they want to increase their capital either from the market locally or internationally, they are allowed to raise the capital without any overall limit. Similarly, the Union Budget 2021-22 has proposed to set up an asset reconstruction company or a bad bank to clean up NPAs of the bank. This is also a very significant reform that has taken place in the Indian financial system, because a very large amount of NPAs, non-performing assets, were being accumulated, or I would say were there in the banking system in the country up to 2000, right? So, in order to clear this mess, Government of India proposed that a bad bank is being created. The idea of the bad bank is all those NPAs can be taken over, or means can be sold to a bad bank, and all the rights of recovering the loan by the bank will shift to the bad bank, and bad bank will over a period of time will keep on trying to recover the money, so that the balance sheet of the commercial banks that are operating in the country, it is being cleaned up. Because whenever any institutions, any individual invest in a bank, buy the shares or invest, you want to raise the capital, any bank want to raise the capital, and banks raise the money to the extent of 10,000 crore, 15,000 crore, 20,000 crore, 5,000 crore, like that, 2,000 means when the bank raises money, they raises the money to around thousands of crores of rupees. So, if there is a large NPS, the investors who are interested in investing the money will think many times. If the balance sheet is clean, then in that case the risk to the investor will be low, and if the risk to the investor will be low, then the investor will be ready to invest in that bank, to fund that bank at a cheaper rate of interest, especially in the international market, right? Because these foreign countries, especially the European countries, the America, the Japan, right? These countries, the rate of interest is very low. They are ready to lend because of excessive capital which they have. They are ready to lend at a very low rate of interest. So, this money will be coming only when your balance sheet is clean. So, in order to clean the balance sheet of a bank or banks, a idea of bad bank was being created, and bad bank is being created in the country, so that all the NPAs, most of these NPAs can be transferred to the bad bank, right? And bad bank in turn will keep on recovering the money over a period of time. Similarly, in the 2023 budget, one of the major highlights was credit guarantee schemes, right? Many times the commercial banks or the other institutions do not lend the money to the MSME sector, to the small scale sector, or I would say they are hesitant, do not lend money, but say are hesitant because of the guarantees, because of the lack of guarantee to be offered by these small business houses. So, Government of India has created a fund that is called the inflow of rupees 9,000 crore into the corpus of Credit Guarantee Fund Trust. So a Credit Guarantee Fund Trust has been created especially for micro and small enterprises, CGTMSC, right? Credit Guarantee Fund Trust for micro and small enterprises. This trust will lend money, or I would say give guarantee for the financing for the purpose of the micro and small enterprise. Means any commercial banks, if it lends money to small and medium, micro, small business, and if there is some NPA issue, if there is some issue, a failure to pay the loan, then this credit guarantee schemes will lend the money to the bank, right? So it will give MSME more access to the collateral free loans, right? So friends, this is basically the evolution of financial system, the three phases we talked about in my previous lecture and this lecture, the pre-independence, the post-independence up to 1990s and 91 2000. Now after talking of this, let me talk briefly about interdependence of financial markets and economic development. That is, economic development and financial markets, they are interdependent. I would say that no country can progress. Economic development is not possible without a sound financial system. And if the economic development is not there or it doesn't take place, then even the financial system will not progress, financial system will not be. So there is an interdependence of financial markets in economic development. That is I would put it this way, more straight way, that economic development depends on, or one of the very important factor for economic development is development of the financial markets in the country. So financial system enables the government to raise both short-term and long-term funds through the issue of bills and bonds which carry attractive rate of interest along with tax concessions. That is, the Government of India is also a big borrower. And when Government of India wants to borrow the money, how does it borrow the money? It borrows the money from the public, it borrows the money from the institutions, right? And through the institutions, public also lend money, the very large scale of the bonds, the money market through instruments, and the bond market instruments are there, which are being floated by RBI of the country, right? And the Government of India offers tax concession to the investors, those who invest the money. So with the developed financial system in the country, the government also can borrow at a lower rate of interest, right? So issue of bills means commercial, it may be government bills, right? So and bonds, and at that the government offers quite attractive rate of interest. When I say, because there is always a relationship of risk and return. I am ready to invest in a bond even if the rate of interest is low, if I perceive that the perceived risk is very low, because we presume that the Government of India, if it is borrowing the money, right, our money is 100% safe. At the time of redemption, we'll get our money back with interest, right? So you are ready to lend the money because you are lending the money to the Government of India, right? So you are ready to lend the money at a lower rate of interest. So what it means is that developed market or the financial market will able to get the money to the Government of India at a low rate of interest, and means it is not only beneficial for the government but even for the investors. That is, the financial market will act as a facilitator between the government and those people who want to invest the money, right? Those who want to invest their hard-earned savings, right? And they will get not only the tax concession but also reasonably attractive rate of interest. Savings are channelized to productive resources, and the role of financial institution is to induce the public to save by offering attractive interest rates, right? I mean, this is, I would say, the basic job of the financial system in the country, any country. Basically, the financial system as a whole, the idea is they channelize the saving from those who have extra income, extra means they are not consuming it, and to the institutions which needs money for investment purposes. So this way the financial system is very, very important for channelizing the public money for productive purposes. Economic development of any country depends on the infrastructure facilities available in the country. Several development banks, like if I say IDBI, ICICI, IFCI, these are all very old financial institutions in the country. They help in raising capital for the industries. So it helps in the promotion of both domestic and foreign trade. Foreign trade is promoted due to pre-shipment and post-shipment finances by the commercial banks. Friends, what we are discussing is basically how the financial system helps in the economic development of a country, right? And they are both interdependent to each other. For development of economy, we require large finances for industrial development, for even not only the industrial development, even for the service sector. India have a very large part of the Indian income comes from the service sector. These service sector, IT related services, all these big companies which are in various services, they need money. Even startups, the startups in India require a lot of capital. We are able to create more than 100 unicorns in the country, and I hope you understand the word unicorn. More than $1 billion of market capitalization, right? So when we are able to create more than 100 unicorns, these startups have created wealth of more than $1 billion. What it means is they need money, and this money will be used for productive purposes, for improving the economy, improving the business, including the service sector in the country, right? So this money will be facilitated by the financial system. So it helps in promoting both domestic companies as well as foreign businesses, and for export purposes also, the companies which are exporting or even importing, for importing purposes, you require money. And these financial institutions, financial system or financial markets, I would say, able to provide the money to these exporters. If I talk of the exports, these exports outside, before the shipment, for manufacturing purposes, for working capital purposes, they require money. Even post shipment, because in the foreign trade, the money, the trade takes place on a large scale, and once you say for example, you are exporting goods worth 100 crore rupees. So the ship will reach to the foreign country after 1 month, after 2 months. During that period of time, your capital will remain invested. So the moment you make the shipment, post shipment, you require money for your other producing goods and producing services. For that purpose, financial institutions provide money. So it helps in providing finance to the foreign businesses. The financial system provides capital to the entrepreneurs who want to start a business. As a result, lot of employment is generated in the economy, right? Means financial institutions helps in creating employment, helps in generating employment in the country. How? By creating economic development, by promoting trade, by promoting business, by promoting industry, right? Because they provide capital. It is the existence of the financial system which ensures that interest remains stable across the country. It also ensures that all the organizations and institutions behave as one unified system. Friends, up till now I was talking about that how the financial institutions helps in channelizing the saving from the savers to the users. Not only this, but even the sound financial system in a country helps in stabilizing the interest rate. Because for development of business, if the interest rate fluctuates too much, means if the rate of interest rises at a very sharp rate or even falls at a very sharp rate, it is not in the interest of the economy. So in order to maintain the interest rate, there is a need to control the money supply in the country. When I say control the money supply, it doesn't mean restrict the money supply, means providing the money supply as per the requirement of the country. For this, you need a stable financial system. You need a regulator, like say for example RBI. Basically, RBI is the bankers of bank. It regulates all the banking system. And whenever we use the word regulate, it does not mean that its job is to put restrictions. But basically, the RBI job is to promote the banking system, to improve the efficiency of the banking system, to promote the money supply in the banking system as per the requirement. And if money supply is being provided as per the requirement of the country, the interest rate will be stabilizing or will be stable. When I say stable, it doesn't mean constant. There will be less fluctuation. And if there is too much of fluctuation, it is not in the interest of the business industry. So what it means is that the regulator or the financial system helps in stabilizing the interest rate, which helps in promoting the business. So it helps the insured organization and institutions to behave in one unified system. So after talking of this, the financial system or financial institutions also helps in providing financial stability in the economy. Financial stability is a state in which the financial system, it means the key financial markets and the financial institution system, is resistant to economic shock and can facilitate real economic activities smoothly. Friends, in these last 10-20 years, there are a lot of upheavals that has taken place in the international economy. Even at present, when the Europe is moving towards the recession, so-called, I would say, put it this way, that people are fearful, economists are fearful that Europe is going towards the recession. Even American economy is not expanding the rate it was expecting earlier. If the international market, the economy is not stable, it is not for our own country also. We can say with pride that Indian economy is moving in a right direction, is stable, the rate of interest are stable, and the system is working smoothly. This is because of the sound financial system in the country, right? So financial stability is important, is essential for any economy. That is, there should not be any financial shocks. If you recollect, in America 2008, I mean, all this scam took place, property scams took place, subprime problem took place. That has shocked the whole world. If these shocks take place in any economy, then it shatters the confidence of the investors, it shatters the confidence of the business, it shatters the confidence of the industry, right? So in order to make the economy stable, the role of the financial institution is very important. Like I was just talking previously, that the RBI provides the money so that the rate of interest remains stable. What is the idea of rate of money remains stable? If the rate of interest starts rising at a very sharp rate or start falling in a very sharp rate, it will be not good for the economy, it will not good for the investors, right? So rate of interest, the stable rate of interest is important, and this rate of interest will lead to financial stability. So our regulators, whether you call it the SEBI, which regulates the capital market in the country, whether you talk of the RBI, which regulates the banking system in the country, if you talk of IDA, which regulates the insurance sector in the country, IRDA, right? The SEBI, which regulates the mutual fund industry in the economy. Their job is to provide stability in the country, and they're a very important part and constituent of the financial system in the country. So the financial system, good sound financial system, helps in financial stability of the economy. Financial stability defines the financial system of a country based on the availability of resources, utilities, loans and employment opportunities. It can also be defined as condition in which the three components of the financial system, that is the financial institutions, financial markets and financial infrastructure, are stable, right. So, all the systems which makes a financial system, whether it is institutions which lends money like banking system, the insurance system, right, financial market like stock exchanges, the two important stock exchanges of the country, the NSE, BSE, right, and the whole host of the intermediaries which are involved in the financial market, and financial infrastructure. Financial infrastructure means the system that is required which facilitates these systems are called financial infrastructure, remains stable, right. Stable means that there should not be shockers in the system. Stable financial institutions are sound enough to carry out their financial intermediation function adequately without assistance from external institutions including the government. So, if our financial system is stable, it will lead to the financial stability in the economy, and it will not be required too much of outside interference, right. That is a very important part for the financial stability of any country. Stable financial market assures that market activity would not be significantly disturbed and that the values of the financial assets would not significantly deviate from the economic fundamentals, right. Normally we say, like, to give an example, too much fluctuation in the stock market is not being considered good, because if there will be too much fluctuations, it means that people will be shy of the stock markets because they are not sure that whether their investment will grow in a right direction, in a right manner. So, financial stability is required for any system in the country, so that to create stability in the economy, so that to create investors' confidence in the system, so that more and more people join the financial system in form of investors, in form of borrowers. So, for this purpose, for this lecture, thank you very much, and we will continue with this financial markets and institution in the next lecture. Thank you.